Talk more about the markets, the Fed, and the overall economy. Joining us is Saira Malik. She is Chief Investment Officer and Head of Equities and Fixed Income at Nuveen, and Joe Lavorgna, Chief Economist at SMBC Nikko Securities. You're both here. That's nice. So I can ask a question, and then all I have to do is just look at one of you. I don't have to single one. I don't have to single one of you out as to who should answer. But now I got to decide who to actually look at. There have been very few days since the 50 basis point cut. I'm looking at you, Sarah. Since the 50 basis point cut, very few days where the 10-year has rallied. The yields have gone up. Is there anything to that? I mean, the Treasury's still got to offer a lot of stuff, does it not? People are going to ask for a certain yield, so there's no reason to think that it's going to just track the 50 basis points. But has it been odd that its yields have done nothing but go up?
Well, I think it's because investors are drinking the Kool-Aid when it comes to a soft landing. And we're even seeing that with earnings season so far, where companies are coming in reasonably strong, especially on the non-tech side. Consumer looks strong. But coming into earnings seasons, what we've seen consistently is consensus lowers numbers coming in, and the bar is pretty low for this earnings season. 4% year-over-year earnings growth expected versus last quarter, which was 11%. So we are still concerned that this soft landing narrative may not play out exactly how investors want. We have the election now 14 trading days away. We also have the Fed. Even though they came in strong with a 50 basis point cut, we've been pricing out 50 for November, most likely 25. So I think yields are telling you that economy's strong, Fed's going to be a little bit slow from here, and that's why we're not seeing yields completely follow the Fed.
Still basing it on what the Fed does. Does anyone care what bond buyers end up doing?
They do, but I agree with what Sarah said, Joe. If you look at the last couple of cycles, 01 and 07, when the Fed cut rates to 150 initially, and the 10-year note actually sold off. You got a steepener with the front end rallying and the long end selling off. So it kind of makes sense. Yeah. So we've repeated history the last two cycles. So going forward, it'll depend obviously on who wins, what happens with the inflation data, which is looking stickier. Do we have the soft landing? I mean, a lot of variables. But the 10-year is kind of doing what it's supposed to. Now it's settled in at this 4% range. You see what happens next.
There was another Wall Street Journal survey, I think, and even more so than last time, the economist the Wall Street Journal talks to thinks that Trump's policies could be more inflationary even than Kamala Harris's. Is that, what do you think they're looking at? That across the board,
at me, right?
Yeah,
that's my question.
I said Joe too.
Okay,
across the board, tariffs.
So look,
they're looking at all these giveaways for taxes.
The problem, Joe, the problem with that is multifold. One is that there's going to be more deregulation. When President Trump took office in 2017, the Federal Register went from something like 75,000 pages down to 60. So you're going to have more deregulation, which could increase supply and productive capacity. You're going to drill, and you're going to re-onshore. And if the after-tax cost of capital is much lower, as it would be arguably under President Trump's policies, that's good for productivity. It's good for inflation.
So
we had low prices
during. It's going to be high.
No, not at all. But you have to remember, like even the CBO, which is nonpartisan, is going to score what the President Trump is saying is being deficit-driven. I don't believe that. If you look at the CBO's numbers in 2016 and where their revenue share of GDP is, and then what happened with the TICJA, the Tax Cuts and Jobs Act, the revenues were met under President Trump's plan. So I think there's a bit of a bias in terms of focusing more on the demand side, not on the supply side. So I don't think the market's right thinking, or that economist survey thinking that it's going to be inflationary. I think quite the opposite.
And so we're going to the election. People, there's an election. Once we get through it, does anything change regardless of the outcome?
Well, I think first it depends how we get through it. So normally in an election year, you do see a little bit of a pickup in volatility. We haven't really seen that this year. But let's also think about what if the election is contested. We only have one data point of that, which is the year 2000, Bush versus Gore. If that happens and we have a delay in who we know who our next president is, that's going to cause a pickup in market volatility and likely the market to decline. Remember, we're going into this election almost at all-time highs. Now, going forward, as Joe mentioned, we do have to think about the expiring tax cuts. There could be up to $4.6 trillion spent to renew those. Also tariffs, bringing more manufacturing closer to home. That could be inflationary. But there's also inflationary pressures that are out of either candidate's hands. Shelter inflation, wage inflation because of the strong jobs market. So there's many drivers of inflation. I think it's tough to say just one candidate versus another will really cause such a pop in inflation.